Hello everyone, welcome back to another episode. I'm your host, the Millennial Investor, and today we are going over 4 different stocks. I just sold 2 of my stocks, I'm completely sold out of them, and I did just bump up my position in 2 different stocks. And the 2 stocks that I sold out of was the one I'm hovering over now, Whirlpool, and I also sold out of a very old blue chip stock. I sold out of IBM. It was a very small position in my portfolio, and I bumped up 1% into Kimberly-Clark. You might know it from all these brands that you can see right here. They're the world's largest distributor of toilet paper, paper towels, napkins, diapers, things like that. And then I also bumped up 2% into Johnson & Johnson. And here's some of their highlights right here. So I'll be going over all of this and then why I sold these 2 stocks and why I bumped up these 2 positions and how it's going to help me with not only my share price gains but my dividend income as well in the long run, as I'm a lot more confident in these 2 business models with Johnson & Johnson and Kimberly-Clark than I am with these 2 business models with IBM and Whirlpool. They were some great positions, but it's time to part ways with them. So overall, guys, in this video, what I'll be going over, I'll be going through each 4, just some basic highlight points of all 4 of these companies through their investor relations page, give some basic background about the companies and where they sit at. I'm going to show you what yields I purchased JNJ at and KMB at, and what yield I sold Whirlpool at and IBM at. And then I'll be going over my reasons for buying them in these little bullet points right here, and then my reasons for selling them in these little bullet points right here. But overall, guys, if you're not used to me, if you're not familiar with my channel, my name is Jordan. I'm the Millennial Investor. Basically, what I do is I track my annual dividend income, my monthly dividend income, my portfolio value, and I even disclose my monthly YouTube income, and there it is broken down in my section right there. And how I do all this is I disclose everything on my channel. I show all my positions, my 29, now down to 27 positions. All of them are disclosed right here in the portfolio. I show you my cost basis. I show you all of my activity. I show you my activity feed showing my dividends, my deposits, my morning trading, everything you could possibly need to know, and how you can support me and my channel if you appreciate the transparency. This refer and earn button here, this little link to share M1 Finance is in the description, and please go ahead and sign up for it if you haven't already, because for the month of September, see these little words right here that I am highlighting, you get $20 just for signing up in the month of September. So if you want to get signed up with M1 Finance, you can now get $20 just for signing up and depositing $100. But overall, guys, thank you guys so much for joining in, and let's go ahead and get started. Now, the reason I did this is, first off, I've been wanting to up my positions in Johnson & Johnson, Procter & Gamble, and Kimberly-Clark, and I've been looking for an excuse to do that, and I'll go over my reasons why I chose these 2. And the main reason is these are pretty good valuations, and I am about to up Procter & Gamble as well, which I'll get more into that in just a second. But in this email, let's go ahead and look at some of the bullet points here. I purchased JNJ and KMB for a better yield than Whirlpool. Whirlpool was a stock that I sold up for over a double up. If we go to my activity feed here, we click activity, and then we see Whirlpool. I sold Whirlpool for $177 a share. I owned Whirlpool at $86 a share. So from where I bought the stock at, it is literally at a double up. This is not the same valuation where I originally bought the stock at. And let's just go ahead and take a look at what their stock chart has done. When I started buying the stock, it was on April 3rd of 2020. And you can see, so when I originally started buying it, it was about $82 a share. And I ended up buying some more, and I got it up to about $86 a share. But look at this share price difference from where I was buying it literally right here, and now it's all the way up here in the 170s. So not the same valuation for where I originally bought it at. That's the main reason why I sold out of Whirlpool, just a dramatic difference. And where I was buying the stock at in the 80s, its dividend was about a 5% yield, and now it's only 2.7. So if it's only going to offer me a 2.7% yield, I would rather sell out of it and get into more of a competent business model like Johnson & Johnson and Kimberly-Clark. But with IBM I mostly sold out of just flat out, it is not as healthy as a company, and I don't want to be chasing yield if hard times come ahead with the stock market or with the economy in general. They've really fallen behind, and I'll be going over my bullet points in that one. But let's go ahead and look at my reasons for buying Johnson & Johnson and Kimberly-Clark. The first one is they are both very safe, stable business models. Both of these companies, especially Johnson & Johnson, are very safe and stable. I want to show you how consistent these companies are. You can see the stock price just gradually goes up over time, and then you see these dividends, 88 cents, 92, 97, $1, $1.03, $1.07, and then I'm sure they're about to raise them again in late 2020. Now, when we look at these stocks, they're so consistent that they have been able to raise dividends for 50 years straight. 50. I'm 21 years old. They have literally been raising dividends over double my age. And when you look at Johnson & Johnson, they have literally been paying dividends since the Great Depression. Not the Great Recession, the Great Depression. Yeah, that's right, in the late 1920s, 1930s. They've literally been paying out dividends since then. And when you're buying into Johnson & Johnson, you're almost buying a healthcare ETF in a way, because they have everything. Like the example I've given in my previous videos, they go as high up to $100,000 surgical equipment, to pharmaceuticals, to basic band-aids when you cut your arm or skin your knee. Whatever the case may be, if it's involved anything with healthcare, Johnson & Johnson is probably involved within it some way. And I guarantee you, every single person watching this video has either seen the brand of Johnson & Johnson, maybe you use their baby powder, maybe you've used their medicine, whatever the case may be. But when it comes to Johnson & Johnson, you've had to at least see their brand, or if not, use them every single day. So Johnson & Johnson is also able to raise that dividend every year from 75 cents to 80 to 84 to 90 to 95 to $1.01. And this dividend raise stays pretty consistent at about 6-7% every single year. And I want to go ahead and show you something real quick with Whirlpool and IBM. When you look at Whirlpool, Whirlpool has had some decent dividend raises. They went from 90 cents up to $1, up to $1.10, up to $1.15, up to $1.20, and now they've held up raises because they're being conservative here in 2020. So they've already skipped a dividend raise. So that's something you have to worry about. Then we look at IBM. Let's look at their dividend. They've went from $1.30, $1.40, $1.50, $1.57, $1.62, and then $1.63. The last 2 or 3 years of dividend raises has been pretty stagnant. Not very much dividend growth because they haven't been growing their business nearly as good as a lot of these other companies have. Now let's go ahead and go back to my bullet points and let's go to incredible track records. Like I said, when we talk about Johnson & Johnson and KMB, they have 50 plus years worth of dividend growth behind them, and these companies have been around for a long time. When we go to KMB here, it's pretty much the same story. They're just in a different category. KMB has literally been around for well over a century. 1872 right here is when they were founded, and Johnson & Johnson is not much farther away from that. Let's go to number 3. More confident in the future, I can sleep well at night. Remember when I showed you about the dividend raises, how IBM has slowed down their dividend raises and then Whirlpool is holding up raising that dividend for a little while? Well, the main reason is that they're not as healthy enough to survive and thrive during recessions like these two are. This is a very defensive company, Kimberly-Clark is, and so is Johnson & Johnson. No matter what happens with the economy, people are always going to need health care. People are always going to need to go to the hospital if they get sick. And then Kimberly-Clark, people don't really discriminate that much about toilet paper. Pretty much people just buy toilet paper when they need it. They don't really think about what their financial situation looks like. So when you look at these companies and you're buying into them, I feel much more confident owning a Johnson & Johnson, and I can sleep well at night knowing that pretty much no matter what happens, no matter what economic turmoil happens, no matter what happens with any kind of virus, anything like that, no matter what, Johnson & Johnson is going to be okay. Kimberly-Clark is going to be okay, and they're pretty much going to raise that dividend every single year, pretty much no matter what. Next up, we have number 4, wide economic moats. Now, when we look at Kimberly-Clark, they have such a dominant brand in the toiletry space, it's really hard for any other competitors to come inside and try to beat them at that. One of the only main competitors that they really even have is, once again, another company that I own, Procter & Gamble, but I won't go into them. They're another large economic moat company, and they're pretty much the only real competitor to Kimberly-Clark. But Kimberly-Clark is the same thing as trying to compete with the Coca-Cola and Pepsi. If you try to create a new Coca-Cola, how are you going to gain market share against Coca-Cola? And if you do manage to do that, you know that they're just going to buy you out. The same thing with Kimberly-Clark. Literally just the other day, they just bought out Softex Indonesia, and that was literally just a couple weeks ago. So that's exactly what Kimberly-Clark does. That's why in this little page here, you can see that they already have targeted 1/4 of the world population. 1/4 of the world population uses their products every single day, and that number is only going to climb upwards from here. And that is why they have such a large economic moat. And Johnson & Johnson has so many different healthcare products that even if they're not the number one in every single category, they're in every single category of healthcare. You can pretty much imagine. So they have wide economic moats behind both of them. Both of them still have considerable yields. So even though both of these stocks are pretty much at all-time highs, this is still getting a 2+% yield. Let's see where I bought it at. I bought Johnson & Johnson at a 2.74, and then I bought Kimberly-Clark at nearly a 3% yield. Kimberly-Clark, once again, basically at an all-time high, just a couple dollars off from it, still buying the stock at basically a 3% yield. So that is an incredible price to be buying at, and once again, was higher than what I sold it for Whirlpool stock. Next, we have dividend raises are consistent, stable, and predictable. Like I said with Whirlpool, Whirlpool held up raising their dividend. I've had some stocks that have done that, and they have to be conservative because if not, it could really hurt their business model. Well, guess what? Johnson & Johnson doesn't have to be conservative. They've already raised it in 2020, and it was actually in May of 2020 that they already raised this. And guess what? Kimberly-Clark, they already raised it in 2020 as well. They raised it earlier in 2020, back in March, right around the downturn, and they have already thrived throughout this recession. That's why they're right back to all-time highs, because they're not struggling. They're not like these other companies. They're not struggling one bit whatsoever. And that's why Whirlpool has held up raising dividends, and that's why IBM has barely raised its dividend, only 1 penny, a fraction of a percent up. Then last but not least, Johnson & Johnson has one of the only 2 companies on planet Earth of a large corporation that has a AAA credit rating. There are 2 companies that have a AAA credit rating. It is Microsoft, a stock that I used to own. I sold it for $210 a share just the other day. I finally sold out of it because it's extremely high valuation. But Johnson & Johnson is one of the only companies on Earth that has a AAA credit rating. That is higher than that of the United States government. So according to the credit agencies, it is more likely that Johnson & Johnson pays back its debt than the United States government. That's pretty crazy to think about. So another bullish reason why I feel so comfortable having Johnson & Johnson in my portfolio, and why it is now one of the largest positions at a whopping 5% right here. I am so happy with this move, and I'm not worried one bit whatsoever. Now let's go ahead and get to the negative side of things. Let's go ahead and look at why I sold Whirlpool and why I sold International Business Machines. Whirlpool at a significantly different valuation from original purchase. Like I mentioned at the beginning of the video, I bought this stock for $82 a share at the beginning, and then I bought some more and it ended up getting up to $86 a share. So look at where this little line is right here. This is around where I first bought it at, and then look at where the price is today. Here, we can go ahead and look at the year chart. I started buying it around this price, right? I started buying it around this price, and look at that upwards move, a double up from where I bought it at, and it's not the same valuation. I remember when I picked up Whirlpool during the downturn in March, and I just thought to myself, wow, this is an incredible valuation, and it has now grown out of that. It grew out of it a lot quicker than I thought it would, but oh well, it's not a bad stock to own. It's just not a better stock to own over Johnson & Johnson. Next, we have IBM has rising payout ratio and declining revenues. Okay, I went ahead and pulled up the income statement for IBM, and I want to show you something here. So let's go ahead and go back to 2016, 4 years ago. This is reported annually. Let's look at the last 4 years. 79 billion, 79.9 billion to be exact. These numbers are in thousands, by the way. 79.9 billion. The next year, 79.1 billion. No growth, actually a little bit of decline. The next year, 79.5 billion. And then the next year, 77 billion. So literally in the last 4 years, they have downtrend. In 2016, they did 79.9, and now in 2019, they did 77.1. I think with me, when I looked at this stock and I first started buying it, when I first started buying this stock, I was originally buying it at about $115 a share, so about right around here. So at $115 a share, it offers nearly a 6% yield. It is incredible how high the yield is on the stock. And I think I honestly just got swayed by the yield of this stock, and that's why I had it at 1% in my portfolio. But the fact that they have declining revenues, but each and every year, we can go back to 2016, they have raised their dividend every single year with that, and that is getting very unhealthy for them. Next up, we have Whirlpool is a consumer discretionary instead of a consumer defensive. Remember what I mentioned earlier with KMB, with Kimberly-Clark, that people pretty much buy toilet paper no matter what. People are never really going to stop buying a $1, a $2 roll of toilet paper. People don't really think about that money that much. But when you think about Whirlpool, if you lose your job, if you're having financial troubles, you might hold off on buying a $500 or $1,000 washer and dryer set versus not buying a $1 roll of toilet paper. If you have Whirlpool, it is consumer discretionary. People can decide what to do with that extra additional income, and if they don't have any extra additional income, then they probably won't be spending it on things like a brand new washer and dryer. But when we look at KMB, Kimberly-Clark is something that is so cheap, like I said, like a Coca-Cola, people don't even second guess to buy it. So that's why this company is a lot more defensive in any recession, not just 2020, but any recession versus a Whirlpool where people are spending their money at a discretionary rate. Next up, we have IBM is starting to fall significantly behind its peers. When we go ahead and look at the stock chart here, you can see where there was a big spike up right before the crash back in the early 2020. You want to know what this big spike up was for? This was announced that their CEO was leaving. Their CEO did not capitalize on all these new growth strategies with cloud or anything like that. They have really fallen behind their peers. And the only way that they tried to compete with that was to buy out Red Hat, another cloud company. And this company has fallen behind so far from its peers like Microsoft and a lot of the other big dogs out there. This company, in my opinion, is going to continue to fall behind. They might continue to struggle and maybe just stay alive, but I think it's inevitable unless there's some major changes with management and basically their overall growth strategy. I think that they'll continue to fall behind and they'll continue to lag its peers. Next up, we have both have either skipped dividend raises or slowed dividend raises. Like I said, I'll just show this one more time. They only raised it a penny in 2020, and then Whirlpool didn't even raise in 2020, and I assume that they won't even be raising until 2021. They've been paying out the same payout since May of 2019. And then last but not least, we have IBM highly leveraged on the balance sheet. I was excited to show this because it's pretty crazy just to see how leveraged they are. I've seen a lot worse, but it's still not very good to look at. So let's go ahead and go to balance sheet. Let's go to quarterly. So this was updated in June 30th, so just a couple months ago. It'll be updated actually about 2 weeks from the time I'm filming this video. But cash and cash equivalents and short-term investments add up from 12 billion plus 2 billion. They add up to right about 14 billion. Okay, now let's go ahead and look at their long-term debt. What does that look like? Their long-term debt is 55 billion. So that's about 3.5, 4 times their cash and cash equivalents, about 4 times. So basically, if they were to try to pay off all their long-term debt tomorrow, they would only be able to pay off 1/4 of it. Just a fourth, a quarter of their long-term debt. That is not very healthy, and so not only are they struggling to pay out those dividends on a long-term basis, they now have to try to focus on paying back that debt because if not, they're losing money to interest, they are a lot more leveraged, they can't get the amount of loans that they could have at good as rates. But overall, guys, I just think it is very unhealthy to keep on owning IBM. I don't want to be chasing yield. I would rather give up a small amount of dividend yield to invest in a much more higher quality company. And that is my reasons for selling Whirlpool and IBM and why I'm buying into Johnson & Johnson and Kimberly-Clark. And thank you guys so much for watching if you made it all the way to the end. These are the investor relations page of all 4 of these: Whirlpool, IBM, Johnson & Johnson, Kimberly-Clark. In the future, who knows, I might be buying back into Whirlpool, but it would have to come back down at a significant valuation from where I originally bought it at. But overall, guys, if you want to support me and the channel, like I mentioned at the beginning of the video, if you want to join me on my journey of tracking my dividend income, my portfolio value, my YouTube income, all that good stuff, one of the ways that you can do that is to go ahead and sign up using this referral link. Like I said, you get $20 for the month of September for signing up, and that is September only. So if you're wanting to do it now, M1 Finance is absolutely free to use. They have some great features, and I would really appreciate it, guys. So thank you guys so much for watching. If you have any comments for me, go ahead and leave them down below. Any questions about any 4 of these companies I just mentioned. And thank you guys so much, and I'll see you guys next time.